Take a look at this chart. It shows us how long-term holders are positioning on Bitcoin, whether they're betting on it to rise or fall. Green means investors are buying Bitcoin, so expecting more upside, and red tells us that they are selling in anticipation of downside. Now look at what these investors are doing today. We're seeing the most aggressive selling since 2018. A record amount of Bitcoin has been offloaded by investors who normally have strong conviction and a long history of holding through volatility. We've only seen similar levels of selling 4 times in the past 8 years, here in December 2024 and March 2024, both of which came right before a 30% correction. Before that, in February 2021, just as Bitcoin was entering a 75% bear market decline, and before that, in December 2018, right as Bitcoin was putting in a major bottom. So heavy distribution from long-term holders has often marked key inflection points for Bitcoin. Today, with Bitcoin down 35% from its all-time highs, many investors believe this signal is pointing to the start of another major bear market, similar to 2021. But to understand where Bitcoin really stands right now, we need to look at the 2 key macro forces that drive Bitcoin's bull runs in the first place. By the way, make sure not to miss the massive discount we're doing on our service to celebrate Cyber Week. We've been taking our clients step by step through this crypto bull run, sharing our trade setups and strategy through 3 weekly premium videos. Our framework has helped us secure multiple double-digit wins while keeping most of our losses limited to around 5%. If you want to follow all our moves in real time, make sure to secure the limited time discount using the link in the description below. The first macro force is liquidity. Now there are many ways to look at this factor, like through global liquidity or through the interest rates set by the Federal Reserve, both of which we've covered in depth in our recent crypto videos. But one major liquidity event that has just taken place is the end of something called quantitative tightening. This chart shows the Fed's balance sheet. Quantitative tightening, or QT, is when the Fed reduces the size of its balance sheet by letting its bonds mature without reinvesting the proceeds. This gradually pulls liquidity out of the financial system. But when QT ends, that liquidity drain stops. And historically, this has marked the beginning of a renewed expansion phase in the Fed's balance sheet. This is essential for Bitcoin because liquidity is effectively the lifeblood of risk assets. When the availability of money begins stabilizing and eventually expanding, again after a period of tightening, financial stress eases, funding costs come down, and risk appetite improves. These are the conditions under which Bitcoin tends to thrive. We can see this more clearly by putting Bitcoin's price on top. The last 3 times when the Fed was expanding its balance sheet, or at least keeping it steady, it led to an aggressive run-up on Bitcoin. And moments when the Fed's balance sheet started contracting, it coincided with a 75 to 80% correction on Bitcoin. Now, what's interesting about the current bull run that began in late 2022 is that it has taken place entirely while the Fed's balance sheet has been declining. We saw something similar in 2012 and in 2019, where Bitcoin rallied by more than 250%, despite the Fed's balance sheet falling. Of course, the big difference is that neither of those rallies made it to new all-time highs, like we've seen this cycle. But this could also be a consequence of accelerating institutional adoption, increasing demand from digital asset treasury companies, and growing accumulation by sovereign wealth funds, all of which were not present earlier. Now, during the last 2 QT transitions, Bitcoin did experience additional volatility in the weeks that followed, but in both cases, it turned out to be mid-cycle corrections rather than the end of the bull market. So with the Fed now nearing another period of balance sheet expansion, it's possible that Bitcoin is approaching a more supportive phase once again. This brings us to the second macro force driving Bitcoin, which is the business cycle. Bitcoin tends to perform strongest when the economy is entering an expansionary phase, driven by growing liquidity and favorable financial conditions. One of the clearest ways to track this is through the ISM Manufacturing PMI. This is a monthly survey that tells us whether US manufacturing is expanding or contracting. A reading above 50 signals expansion as factories are producing more, orders are picking up, and economic conditions are improving. A reading below 50 indicates contraction as businesses cut back on spending and growth begins to slow. And when the PMI is around 50, it suggests the economy is in a neutral state, so neither accelerating nor slowing down. Every time the PMI has risen sharply from below 50, it has marked the beginning of an economic recovery and expansion phase. And historically, that's when Bitcoin tends to see its strongest rallies, because economic acceleration boosts investor confidence and unlocks more speculative capital, both of which are fuel for risk assets like Bitcoin. And the opposite happens when the PMI falls from high levels to under 50, indicating an economic contraction, like in 2011, 2014, 2018, and 2021. These are instances when Bitcoin also tends to see its sharpest drawdowns. Now, throughout this Bitcoin bull run, the PMI has been hovering around the 50 level. In other words, Bitcoin has been rising during a period where the economy has essentially been neutral. This is very different from the textbook bull runs of the past, which were fueled by a clear pickup in economic activity. But if the PMI were to turn higher from here, it would put us in the same kind of macro environment that has historically supported Bitcoin's strongest rallies. And this is where the Fed's balance sheet comes into the picture once again. If we replace Bitcoin with the Fed's balance sheet, we can see a very clear relationship. When the Fed's balance sheet is contracting, it has led to a slowdown in the broader economy. And when it's expanding, it has helped kickstart economic expansions. And this makes sense. The Federal Reserve injects liquidity into the financial system by purchasing assets and expanding its balance sheet. Those purchases lower borrowing costs, ease liquidity conditions, and support credit creation, all of which help drive economic activity. Now, with quantitative tightening coming to an end, we may be nearing another inflection point for the business cycle. And once the Fed transitions back towards balance sheet expansion, that could be the catalyst for economic activity to pick up again. In fact, we're already seeing signs of this. If we zoom out and replace the Fed's balance sheet with the General Business Conditions Index from the Empire State Manufacturing Survey, we see a very close relationship between the two lines. This index is a measure of how manufacturers are reporting changes on more immediate conditions like new orders, shipments, and inventories, giving a more real-time read on shifts in economic momentum. Recently, this index has started to turn higher, suggesting that economic activity may be in the early stages of improving. And if this relationship with the PMI continues to hold, then the recent improvement in business conditions may be signaling that the economy is about to pick up. So we're heading into an environment where the Fed is moving from quantitative tightening toward easing, while the broader economy is showing early signs of acceleration. This is the kind of macro backdrop that has historically supported strong rallies on Bitcoin. That, of course, doesn't mean price can't remain volatile in the near term. Bitcoin has broken below all of its key moving averages, and each of them is beginning to curl down. So yes, momentum does not look constructive right now. But based on the liquidity backdrop through the Fed's balance sheet and the early signs from the business cycle, we don't think this sets up for a 75% bear decline like what we saw in 2021 and 2022. The next key level we're watching is this trend line around $80,000. We'll be looking to potentially capture a trade once Bitcoin begins to base around that region. We know that making money in the crypto market is not about predicting the market. It's the art of making calculated bets with controlled risk and knowing exactly what could make you wrong about your thesis. A quick reminder that we're doing a 40% discount on our trading membership that gives you access to every single trade that we take with alerts for when we enter and exit trades. In the past year alone, we've had multiple successful trades, with gains like 30% on Bitcoin, 36% on Solana, and 83% on Ethereum. And the ones that did not work out were mostly limited to around a 5% loss. You can see all of our closed trades on our homepage for free. If you're interested, capitalize on the discount using the link in the description below.